PantheonAI presents U.S.-China Trade Deal, Markets Mixed, Nasdaq Breakout, Bank Stocks Rally, Tariff Relief Boosts Retail. Welcome back to the PAI Morning Briefing, everyone. I'm your host, here with Host B.
Good morning, Host A, and good morning to all our listeners. It's May 12th, 2025, a crisp spring day. And boy, do we have a lot to unpack from the markets today.
Absolutely. Let's dive right into it with a quick market overview. Looking at the major indexes, the S&P 500 is sitting right around 5799.56, showing a slight dip, down about 0.13% today.
Okay, so a little bit of red there for the S&P. But the Dow Jones, interestingly, is showing some strength. It's up around 42,129.74, gaining about 0.55%.
Right, a bit of a divergence there. Over on the Nasdaq, we're seeing a slight pullback. It's near 18,542.48, down roughly 0.71%.
And the Russell 2000, representing those smaller cap stocks, is also down a little over 0.3% at about 2,080.27. So a bit of a mixed picture across the major U.S. indexes.
Definitely mixed. And switching gears to crypto, it's also a bit of a mixed bag there. Bitcoin is trading around 102,558.94, shedding about 1.51%.
And Ethereum is also down, near 2492.15, dropping approximately 0.90%. So yeah, digital currencies adding another layer of complexity to the overall market view.
They certainly do. Let's take a few minutes now to really unpack these numbers. You know, minor day-to-day fluctuations like these, they keep us on our toes, but sometimes those subtleties hold deeper meaning when you look at them in the broader economic context.
That's a great point. Like the S&P's slight dip, you could see that as just a momentary pause, maybe against some underlying resilience, especially because we're seeing some encouraging signals in sectors like tech and banks, which we'll talk about.
Exactly, and the Dow's upward move, that really reminds us that market sentiment isn't uniform. There's clearly some optimism, perhaps in areas like industrial production or infrastructure, which tend to be weighted heavier in those blue-chip stocks.
True, but then the Nasdaq's pullback, that does seem to highlight the ongoing volatility in the tech sector. It feels like that's where investor optimism often bumps up against the reality of earnings pressure or regulatory chatter.
Speaking of earnings, there's an interesting piece of news that could potentially redefine narratives for some stocks this season, even with that backdrop of a cooling economic environment.
Oh, you mean that recent report? The one that highlighted 20 stocks showing excellent earnings season trends, even though overall U.S. economic growth turned negative in the first quarter?
That's the one. And what's intriguing about it is that it really seems to underscore which companies might be better positioned to weather potential disruptions, especially when you think about the lingering impact of those Liberation Day tariffs President Trump announced back on April 2nd.
Yeah, it's kind of a curious phenomenon, isn't it? Even when the traditional economic growth indicators look a bit sour, you still see these pockets of significant strength emerging in corporate earnings.
It really is. And another technical breakthrough that's getting a lot of market chatter is the Nasdaq Composite breaking back above its critical 200-day and 100-day moving averages.
Okay, so those key technical levels, what are they sitting at now?
The 200-day is around 18,320.79, and the 100-day is about 18,476.49. So breaking above those is seen by many as a pretty significant signal.
Right. It suggests a shift in the medium-term trend for a lot of investors, maybe signaling that the long-term bullish trajectory could be getting reestablished, despite the minor setbacks we're seeing today.
Exactly. Though naturally, any move like this calls for cautious optimism. Technical indicators can sometimes give signals that reverse quickly, but it definitely has a bullish tone that many traders and long-term holders will find reassuring as we head into mid-year.
Speaking of market watchers, the ever-entertaining Jim Cramer is, as always, right there with his finger on the pulse. He's compiled his top 10 things to watch for this Monday.
Yes, his list seems to have really resonated. He noted that stocks are soaring after the U.S. and China agreed to temporarily slash their tariff rates.
That's just another illustration, isn't it, of how geopolitics and trade policy continue to play such a major role. They really set off those waves of confidence, or sometimes anxiety, across global markets.
It really feels like the markets sometimes react faster than we do to holiday sales announcements at our favorite stores, doesn't it?
A little bit, yeah. But it's not just about tech and tariff agreements. Let's talk about the financial sector, because bank stocks have actually experienced a broad rally lately.
They have, and the prevailing sentiment there seems to be mitigating fears of a recession. A lot of that is thanks to the hopeful news coming out of those U.S.-China trade talks.
So with potentially more favorable tariff terms on the horizon, investors are betting that increased economic activity will naturally boost financial performance?
That seems to be the dynamic. And it's intriguing because these developments don't just raise the stock prices of banks, they also instill a kind of cautious optimism throughout the broader market ecosystem. It's like watching someone gradually climb out of a tight spot. The initial signs are there, and while it's measured, it's certainly a welcome development.
That's a good analogy. And adding another layer to our narrative, some consumer-focused news is also making waves. There's a notable headline about how this recent U.S.-China trade deal has provided some much-needed relief for consumers, sending retailer stocks surging.
That's particularly heartening for the consumer discretionary sector, which is so sensitive to shifts in consumer confidence and macroeconomic uncertainty, especially with tariffs involved.
Right. When consumers feel more secure about their spending power, it's not just good news for retail, but for all those service industries that rely on robust consumer demand.
It really is. And I think at this point, it's important to acknowledge how all these diverse threads interweave to form the larger tapestry of today's market outlook. You have individual sectors responding to both domestic developments and global geopolitical signals.
It makes you wonder, are we witnessing the convergence of a multifaceted recovery, or is it just diverse responses to localized stimuli?
Exactly. As investors, we're challenged to decode all this information and figure out how to strategically position our portfolios long-term.
Let's maybe take a deeper dive into some of these major trends. On one hand, that Nasdaq breakout above its moving averages. That's not just a technical adjustment, is it? For many investors who've been patient through volatility, it feels like a reaffirmation.
Totally. Technical analysts will point to that as a critical signal of medium-term recovery in tech. But then you have fundamental analysts who might still look at the lagging performance of some tech giants with a skeptical eye.
That divergence in views really underlines one of the timeless truths of investing. There's no one-size-fits-all narrative that lasts for long in the stock market.
So true. And then there's that ripple effect from the improved trade dialogue between the U.S. and China. The tariff reduction is proving to be a practical catalyst, isn't it?
It really is. Not only is it prompting a rise in bank stocks, but it's also bolstering the consumer retail segment. We're seeing this blend of a technical rally and a sentiment rally, which is a cocktail many investors find particularly inviting for diversification.
Definitely, though we should always be wary of riding the wave too enthusiastically. A technical breakout is encouraging, yes, but those broader economic conditions, like the negative Q1 growth reported earlier, remind us to keep a balanced perspective.
There's kind of a bittersweet note to that recent earnings performance, isn't there? While earnings season highlighted resilience in those 20 standout stocks, the overall economic growth in Q1 was negative.
It leaves us with that interesting conundrum. Are these isolated cases of success that might eventually redirect the broader economy? Or are they simply anomalies that will correct themselves as economic fundamentals catch up?
Yeah, it's questions like those that really keep our morning briefings as lively as they are informative.
Let's shift now and look more granularly at some of the top stories making headlines. There are few news items that continue to really churn discussion among market observers.
Okay, what's the first one that stands out to you?
Well, that in-depth report on the 20 stocks with excellent earnings season trends, especially amidst a slowing economy. That's particularly interesting because it highlights companies that, despite the negative headwinds from Q1, managed to post robust results.
Right. It really points to business models that are either inherently resilient or just exceptionally well managed during uncertainty. And it does beg the question, will these earnings trailblazers continue to outperform even if the broader economic outlook stays dim?
Exactly. For those of us watching these patterns, it's a good reminder that quality companies can shine even in less than ideal conditions. What's next on your list?
Next up, I'd say that Nasdaq technical update. As you mentioned earlier, that break above the 200-day and 100-day moving averages, it feels like more than just a fleeting moment. It suggests momentum could be shifting.
Technical indicators like those moving averages have long been considered the backbone of medium-term trend analysis. That being said, even seasoned analysts will tell you no indicator is infallible.
True. But when you see such a breakout, it can give investors confidence to reallocate resources, maybe favoring tech and growth stocks that have seen a bit of a pullback recently. And while some joke that the only constant in markets is change, you could argue it's precisely these changes that create opportunities for the vigilant trader.
Good point. And Jim Cramer's top 10 list, always a recurring motif. His focus on soaring stocks following the temporary tariff reduction certainly grabs attention.
Yeah, Jim's insights are usually that mix of hard-hitting data and his distinctive bravado. His top 10 list isn't just an agenda. It often feels like a call to arms for those eager to ride market trends.
Definitely. And even though his remarks might sometimes feel theatrical, there's usually an underlying current of strategic advice that savvy market participants filter and integrate.
Transitioning to the banking sector, that rally in bank stocks has been widely covered. Some analysts say it's purely driven by the optimism around the improved U.S.-China trade talks.
It really shows how intertwined global politics are with domestic financial performance. When banks rally, it's often seen as a barometer for economic recovery, because financial institutions are directly linked to consumer spending, corporate investments, even international trade financing.
Yeah, the broader rally in bank stocks isn't just comforting to investors wary of recession fears. It's also a positive signal that maybe we're entering a phase of renewed economic vigor.
And on the consumer front, the narrative has definitely shifted, thanks to that U.S.-China trade deal easing some macroeconomic uncertainty. Retailers, especially in consumer discretionary, have benefited significantly from the easing of tariff anxieties.
When consumers start spending more, the effects really are felt across nearly every segment of the economy, from manufacturing to services. That surge in retailer stocks is a direct reflection of this sentiment.
And it raises the question, could this consumer lift be a precursor to a broader economic turnaround, or is it simply a temporary respite?
Exactly. All of these developments have deeper sector implications that we really need to pay attention to. In tech, for instance, despite a slight overall dip in the Nasdaq today, we're seeing pockets of impressive innovation and market recovery.
That technical breakout definitely suggests investors might be regaining confidence in tech names poised for growth, even if short-term profit warnings or regulatory concerns linger. It's that classic tale of volatility meeting long-term strategic investment recommendations,
which requires both a keen eye on quarterly performance and a commitment to broader, often intangible trends like innovation and market penetration. Now, in the financial arena, bank stocks are clearly leading a rally.
The connection between improved trade negotiations and that rebound in bank stocks really emphasizes how diplomacy and financial markets have their own complex dance. Something as seemingly distant as tariff negotiations can have immediate, palpable effects on bank valuations.
It speaks to the complexity of modern financial systems, doesn't it? For those of us with a stake in these markets, it can be both reassuring and a bit nerve-wracking to see such direct correlations between geopolitical events and our day-to-day portfolio values.
Definitely, and if we shift to sectors like retail and consumer discretionary, we see a similar story. The easing of trade tensions has helped some lesser-performing retail stocks rebound, offering a glimpse of potential recovery in consumer sentiment.
In times of uncertainty, every positive sign can send ripples far and wide. An uptick in consumer spending doesn't just fuel retailer earnings, it also bolsters confidence in sectors like transportation and hospitality. It's a complex, interconnected web.
And one change in the diplomatic ambiance can lead to an avalanche of repercussions in the market. Before we wrap up our news review, let's touch on some of the recurring themes we're seeing today.
Okay, what's standing out to you?
Well, the impact of the U.S.-China trade talks is everywhere, right? It's in the bank stocks, it's in the uplift of consumer retail. The repeated references in several news articles really emphasize that this trade deal is more than just a fleeting headline. It's a strategic pivot many are watching closely.
What does that tell us? In an increasingly global world, even bilateral agreements can send shockwaves across numerous sectors, prompting investors to reconsider geographical and sector-based allocations.
Exactly. And in the realm of expert insights and predictions, many analysts suggest that while the market is clearly in flux, the undercurrents seem to be leaning towards eventual stabilization, provided these improvements in trade relations and technical indicators maintain momentum.
There's a fair amount of speculation, isn't there, about whether the short-term volatility in tech and crypto will give way to a more stable medium-term trend.
For sure. I heard a market analyst once quipped that predicting the markets is a bit like predicting the weather while riding a roller coaster. That might be an exaggeration, but it certainly underscores the inherent challenges of forecasting in such a dynamic environment.
Ha! Yeah, that feels pretty accurate sometimes. Beyond our immediate domestic market analysis, there are important global implications to consider. The renewed interest in U.S.-China discussions isn't just an American or Asian phenomenon. It resonates worldwide.
Absolutely. Global investors are closely monitoring these developments because trade tensions and their quick resolution have far-reaching implications for emerging and developed markets alike. From European equities to rising stars in Asia, the interconnectedness means a favorable trade arrangement can set off positive ripples far beyond U.S. borders.
And global markets are also watching the crypto space. Bitcoin and Ethereum, despite recent declines, are still seen as part of that broader narrative of digital decentralization and alternative investment pathways.
In many ways, the cryptosphere continues to serve as a barometer for investor risk appetite. The fact that traditional financial instruments and digital currencies are now part of the same conversation reflects the evolution of investment landscapes.
It really does. And it raises some thought-provoking questions. Could the volatility in digital currencies spur further innovations in blockchain technology? Or will regulatory pressure curb its momentum in the months ahead?
Great questions. As we step back and reflect on all these trends, it's apparent the market environment is as layered and complex as ever. Different sectors have different stories short-term, but ultimately they're all pieces of a larger puzzle that's constantly being reassembled.
It makes you wonder if the market itself is kind of like a living organism, responsive, adaptive, and always hinting at the delicate balance between optimism and caution.
That's a good way to put it. So far, we've covered a wide array of news and updates, but let's just quickly wrap up by touching on some detailed sector analyses and that broader global picture again.
Okay. In the technology sector, despite the slight dip today, the overall trend does seem set for gradual recovery. That Nasdaq breakout above its moving averages is a particularly positive sign, and many tech stocks under pressure might see upward revisions.
But, as we know, the tech world changes rapidly. While short-term traders might benefit, long-haul investors need to be ready for the ever-present risk of corrections.
True. What about energy? It hasn't featured as prominently today, but it's still critical.
It is. The discussion there often centers on the interplay between global politics and supply chains. Even small shifts in geopolitical sentiment can lead to adjustments in energy stocks. It's a silent but persistent area for keen-eyed investors.
And in finance and banking, that recent rally is really providing a counterbalance to some of the tech volatility. Improved U.S.-China trade relations and tempered recession predictions seem to be boosting confidence.
Bank stocks rallying steadily indicate not just improved sentiment, but a readiness for a possible uptick in lending and economic participation. It's a sector where trust is paramount, after all.
And speaking of trust, sometimes analyzing the market can feel like trying to decipher a friend's cryptic text messages, only with a bit more coffee involved.
Haha, definitely. And we can't overlook that palpable shift in consumer sentiment impacting retail and consumer discretionary. The easing of tariff fears reflected in surging retailer stocks suggests consumer confidence might be on the upswing.
This is especially relevant for companies that have been struggling with earlier spending uncertainties. When consumers feel more secure, it tends to lift nearly every facet of the economy, from small local businesses to large multinationals.
Globally, the ripples of improved U.S.-China relations could extend well beyond our borders. Enhanced trade terms could invigorate international trade partnerships. European markets might see increased stability, and emerging markets could benefit if global activity spurs higher demand for raw materials.
And when we talk about expert insights and predictions, viewpoints are varied, but there's an underlying optimism. Many analysts believe that while short-term volatility will likely persist, the market seems to be setting up for a period of stability as key sectors regain momentum.
They note that technical breakthroughs like the Nasdaq's, combined with improved trade dynamics, could catalyze a broader rebound in the coming months. But, as always, they remind us that patience and diversification are our most trusted companions.
Absolutely. Before we sign off, I wanted to leave our listeners with a few questions to ponder. As investors and traders, how do you balance the excitement of a technical rebound with the underlying economic headwinds that might still be present?
Good one. And what does the ongoing transformation in consumer sentiment mean for the long-term sustainability of the current rally across various sectors?
And perhaps most importantly, in this ever-evolving financial landscape, how much should you lean on traditional market indicators versus emerging signals from global political events or even digital currencies?
It's such a fascinating time to be involved in the markets, and these questions don't have easy answers. But that's what makes pursuing understanding our economic environment so engaging.
It really is. We encourage you to reflect on these as you review your portfolios. Informed decision-making truly is our best tool in navigating these unpredictable times.
So, as we wrap up today's PAI Morning Briefing, let's just summarize the key takeaways. We're seeing major indexes showing cautious optimism and minor volatility, with that bullish technical signal from the Nasdaq's breakout.
The banking sector is rallying, buoyed by stronger U.S.-China trade talks, while the consumer sector finds relief from easing tariff tensions.
Technology continues to show signs of recovery despite intermittent pressure, and even the crypto market, with Bitcoin and Ethereum seeing declines, remains an important part of the broader conversation about risk and digital innovation.
We've woven in expert insights, juxtaposed technical indicators with real-world economic news, and underscored the intricate interplay between domestic developments and global implications today.
Whether you're watching your index funds, dabbling in digital currencies, or rebalancing your sector allocations, there's certainly no shortage of factors to consider.
Thank you for joining us on today's briefing. We hope you found our conversation informative and engaging and maybe enjoyed the occasional lighthearted remark as much as the analysis.
Remember, all this financial insight and market pulse can sometimes feel overwhelming, but learning shouldn't feel like a full-time job.
Before we sign off, a big shout out to PantheonAI, your information co-pilot in this complex financial journey.
Come back tomorrow for another episode where we'll dive further into the trends and unravel more market mysteries. And as always, if you have questions or need a deeper analysis, you can ask our AI co-pilot.
Until next time, keep your eyes sharp, your questions coming, and your strategies well-balanced.
Have a great day and happy investing.
PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.